Welcome to the Wade Borth podcast, where knowledge unlocks new paths and simple steps today create powerful changes tomorrow. Let's get to it.
Hello, welcome back to the Wade Borth podcast. Today, I have a special guest. Always exciting to have Kira Nyland with me to have a discussion about really just about what we're hearing from our clients, kind of person on the street questions. It's things that come up on a regular basis that I know everybody at least has heard or is engaged in a conversation with their people or their family, or really with maybe even with their agent. And I thought maybe we'd take the opportunity today just to address some of these questions, because again, it's all about the conversation. It's about, let's find some awareness, like what do we not know? And then let's find some education to fill that void, and like what is the opportunity to take some action to address those issues, if there's issues within your financial picture that need to be addressed. So today, we're just going to kind of open it up. We're going to ask a number of different questions that we hear kind of on a regular basis, or that we hear on the street. And I just want to be able to address some of these so it's helpful for you, the listener. Now I have a better understanding. And if I'm going to make a decision about, what product am I buying? Why do I have what I have? You're making it out of an informed decision versus you're making a justification of why you own something out of like lack of knowledge. And so I'm always a firm believer, like all decisions are good as long as they're made out of an informed decision. So really what we want to do today is kind of help lift the veil a little bit, shed some light, pull the curtains back, whatever you want to call it. And we're just going to go into a number of different questions that Kira's heard, that I've heard, that we've heard on the street, that we hear in social media, all the different places we hear, but it really kind of boils down to a handful of questions. And so thanks, Kira, for joining me today, and thanks for bringing the questions. And we're going to take these, and like I told you when we first started, let's nothing is nothing is off the table. We can talk about anything that you're hearing. And as we go through this, always feel free to have us expand on it, because again, I always kind of laugh at myself, because when you're in the business as long as I've been, you just assume everybody knows everything that you know, and so which isn't true, because even though I drive a car, I don't know everything the engineers know, how they put the car together. And again, the engineer might like, well, it's obvious that, you do this thing, and this is how the car works. I just turn the key on and I go. It serves me, it serves my purpose, and I go. And so a lot of times with financial products, it's kind of the same way. You don't necessarily need to know all the details, all the ins and outs, but how does it serve you? And so really what we're doing today is just helping people raise their level of understanding of the products either they want to buy, maybe that they have, or just get them to think a little bit more like, oh, maybe I need to have a deeper conversation with Wade and his team to talk about where does this fit in within my life or within my financial picture. So thank you for joining me today.
Yeah, it's been a while.
Yeah, it's been a while. So, well, let's get into it. Kind of what do you hear? I know you work with me, and so we talk. What do I talk about all day long? I talk about life insurance. It's what I love. It's what I do. But you also, you've had some experiences with life insurance. You've had some, before we met, there's been some experiences in your life that kind of raised your level of understanding of the industry that we're in, and really the importance of the industry we're in. But I just want to kind of address some common myths, some things we hear, and we just want to expand on those conversations. So feel free to ask me anything that you've heard, that you really your questions maybe as well.
Yeah. So one of the things that we first started talking about was the difference in term insurance versus whole life. Obviously, you're a big proponent for whole life over term, but there are people who just prefer to have term insurance, whether or not it's, because they don't know any better, or they've, again, the whole education aspect, like you said, be informed, make better decisions. But I think it's also, when you look at it from a 30,000-foot view, it's somewhat easy to understand why people tend to maybe lean towards term insurance. Same benefit, the premium difference. But the first thing is, why do certain financial advisors promote term insurance as being a better option than whole life?
Yeah, I think kind of just to answer that question is like anything else in the world, it's not right or wrong. I always want to address this as like, it's just a product. Term insurance is a product, whole life is a product. Everything that's out there is just a product, right? Mutual funds are just products. And it's the craftsman and how they use their tools, to build the house. That's the part that we want to look at. And we need multiple tools to build a house. So as we were building our financial house, they're just different tools that we're using. So we just want to make sure that we're using the right tool in the right location, the right position, so it can serve us and be beneficial for us. But you bring up a really good point. Why are certain people always promoting term over everything else? And I really believe, and I'm going to talk about some of the financial entertainers that are out there to start with, that are always promoting, well, buy term, invest the difference. Why do they do that? I really believe that's probably started out of a couple of different things. One, which I'm not 100% sure that I don't know people's minds, so I'm not going to ascribe any kind of, what they think type of area, but I look at it as like they really understand what it's doing. Have they taken the time to study and understand what it is? Right. Whole life insurance is just really, in essence, if you break it down, it's a liquidity contract. It provides you liquidity at the time of death. And if you use whole life, it really provides you the availability of liquidity between that time of death and every time before that. And at its core, it is just really a professionally managed bond and real estate portfolio done at this big, large institutional level for your benefit, guaranteed never to go backwards. Now, if you've listened to my podcast, you've probably heard that said before, but let me just say it one more time. It's a professionally managed bond and real estate portfolio, because that's what the insurance companies invest in. That's done at this institutional level. They're getting deals that you and I as a common consumer would never get. And when they buy in multi-millions dollars blocks. And so they're getting this huge discount, and they're getting they have these professionals. They have people that all they do all day long is look at bond and real estate deals and say which ones are good, which one fit our portfolio, so on and so forth. And they pass on more deals than they'll ever take in. And it's done for our benefit, right? So that's why I love whole life. It's that key foundational piece. Where I see advisors and I see financial entertainers they want to take one thing, they want to take this hammer and make it as a screwdriver. They want to use it as it's sometimes easy. If I'm a financial advisor and I make my money on moving assets under management under me, then the whole point is like, I'm going to probably say, don't put your money in whole life, put your money in term. Because again, as an advisor, I still ascribe positive intent to that individual. They want you to have coverage, but then they want you to move their money to their assets to manage, their bond fund or their real estate fund or their stock fund or whatever it is, because that's truly in the long run where they make their most money. And we've done that calculation before. We actually have. They're so much lower. I said, yeah, maybe in the short run that's true, but over the long run, how does that play out? And we've done the math, and we've worked with Todd Langford over at Truth Concepts, and we've done the math of showing that where people make the biggest dollars in this industry is if you have assets under management, if you have mutual fund portfolios. Those are the people that make way, way, way more than what the insurance industry makes. And just to prove that out, if it was truly as quote unquote big of difference in who makes more money, Wall Street would be selling whole life insurance. Mm-hmm. So they would migrate and they would take over that space, but they know that they're true, where they can really control people's money and can really control people's or their ability to earn a stream of income. The brokers and the Wall Street is they sell their products. And again, I'm not saying that they're bad products. They have a place. But again, I just always want to make sure that we understand where their conversation is coming from. So, the whole idea of hey, I should, people are always saying buy term, invest the difference. And I'll say why. What's the alternative? Let's find some education. Let's find some understanding and make a decision based off of knowledge versus, the lack of knowledge. And that's all I'm saying. So, and to that point, I love term insurance. I think you made a comment like, I like whole life over term insurance. They're similar tools, but they're complete. So,
well, yeah. And to kind of go back to the price standpoint. So something that from a person who maybe doesn't have the knowledge about, the two different policies, perfect example, we have a term insurance policy on me because before I started going back to work, I stayed home with my now 8-year-old, and we had a term policy in the event that God forbid something were to happen to me. That the plan was for that policy to help with childcare expenses, school expenses, things like that, that I was essentially doing as a stay-at-home parent. Now, with that being said, if you take the benefit of our term policy and you take the same benefit amount and pop it into a whole life policy, obviously the premium amount is going to be significantly less. And I feel like that's what drives a lot of people to feel like term insurance is potentially a better option for them, because they look at the, again, they look at the present value, if that's the right, present at the time they're making that payment every month, right? They're not thinking about the long-term aspect of it, pardon the pun, but they're thinking about that, present value of, oh, I'm only paying $12 a month, I'm paying $20 a month for the policy, as opposed to going, hey, I'm dropping $200 a month, or I'm dropping $5,000 a quarter, whatever it breaks down to. So how would you kind of I guess debunk that fact in people thinking and looking at the initial price tag?
Yeah, I don't even, I wouldn't even use the word debunk, because I think there's some truth to it all, right? So again, it's like, what is the purpose? So let's go back to the idea of term versus whole life. It's your time horizon, it's your perspective, and the purpose. What you get with term insurance is you get one benefit, and that's the death benefit.
Mm-hmm.
Now, what you don't get that is a guarantee of that death benefit. You get that death benefit for a certain amount of time. So it's a guarantee of maybe 20 years or 15 years. And that might be the purpose it needs to serve. And if that's the case, then it's exactly the right product for that time frame. So it's not right or wrong. It's just, is it being used in the right context? Does that make sense?
Mm-hmm.
So that's the first thing. And so why versus whole life, which says it's a 100% guarantee benefit to pay. It will pay when you die, no matter if that's 5 years from now, or if that's 50.
Right.
So it shifts that risk. But again, if somebody says, I need it because I want to make sure that in your case, the child care part of it is like you're taking care of your son, and that's the most important thing, and that's what that needs to be covered. That's doing exactly what it needs to do. Mm-hmm. So perfect. It's the right product in the right position. What if we need it for other purposes? And we can have a lot of other discussions about the other purposes, right? If we talk about it, we've done a podcast on this before, where we talk about the 8 benefits of whole life, and really there's more than that, but there's eight main benefits. Death benefit being just one of there's 7 others that go along with it. If you want to, we can go back and we'll link the 8 benefits of whole life podcast into this one, so you can kind of understand what the other benefits are. So we'll add to the show notes. The other one says, hey, I have multiple reasons to own it. Again, this is where the education and the understanding comes in. It does say sometimes, like, why am I buying this asset? Is it my safe, secure bond asset? Is it my safe, secure savings vehicle? Absolutely. If that's the case, you want to put more in. And so death benefit being one of them, but then there's all these other benefits that go along with it. The other thing about term insurance and just pricing, when we look at pricing, the realization is that insurance, statistically, they don't pay benefits on those. I've seen it's as low as 1%. Of all the term insurance policies out there, only 1% ever pay a claim. So because it's, you think about it. If I'm 40 years old and I take out a 20-year term, I'm 60 when it ends. Well, the likelihood of you being able to pass a physical, get a policy with how it needs to be priced. So therefore they can charge a smaller premium.
Okay, so let me see if I understand what you're saying. So policy that we got on me, I think I was, well, we'll just say I was in my early 30s.
Yeah, okay, perfect.
So let's just say that, I go out tomorrow and God forbid something happens to me. There's still plenty of time left on my policy. But are you saying that the likelihood of that policy actually paying out for the benefit is slim? Did I understand that?
So let me thank you for the clarification. If you walked out the door today and stepped on the street corner and get hit by a bus, that policy would pay a death claim. So what
we wrote it for initially.
Right, it absolutely would. But if I take 1 million people just like you, just same health, same age, same everything, very similar to you, and I put 1 million people out there,
Okay, got it. It's almost like a cash cow for an insurance company,
Well,
kind of.
yes or no. I mean, and this is probably the misconception. There is no deals in the insurance business. And so why do they charge the premium that they charge? Because they know from actuarial science that there's a very low likelihood they'll have to pay out more than 1% of the claims that are available in their book.
Okay.
And so they charge a very small premium because they know that the likelihood from that large group is pretty small that the claim will have to be paid. Now, if you step off a street corner and get hit by a bus, your family, it's 100%, it's 100% likelihood that, that event happened to you. So we look at it from like a micro standpoint. That's how consumers look at things, from a very micro standpoint.
Yeah.
In my world, the story about my dad dying, and he dropped his life insurance, 6 months before he died. That event was 100% to us, right? We were in it, and it happened to us, and it was awful.
Yeah.
But from a very large standpoint of large insurance companies that have maybe maybe they have 1 million policies in force on people that are in their early 30s. They just know statistically that they're gonna pay very few claims, so therefore they charge accordingly.
Right. So I'm a big analogy person. That's a
Yeah.
lot of times how I process and understand things. So a lot of people I'm sure have noticed that their auto insurance premiums are kind of just absolutely skyrocketing. At least they are where I'm currently living.
Right.
It's a little ridiculous. But that is probably because the actuary data is that too many people are on their cell phones, too many people are distracted, they're not paying attention. So what's happening is now those policies and those premiums are rising because they're having to make so many payouts. So is that kind of what you're saying with term insurance? Term insurance, the likelihood of statistically paying out a term insurance for somebody that fits my mold is very slim. And so that's why they keep those policies low. But if it were, just like the comparison, the analogy part of it, would you say that's fairly accurate?
Fairly accurate, right? Yeah. So the claims they're going to pay out are small, and again, auto insurance is a little bit different because there isn't, but just auto insurance in general, you're exactly right. The more claims an insurance company has to pay out, the higher their rates are.
The premium goes up. Yep.
So people look at the price of term insurance and they go, "Oh, these are cheap." Well, yeah. Again, the likelihood of it paying out is pretty small. Like whole life, on the other hand, the likelihood of death is 100%.
100%, right.
So they
What
know
you say there's two guarantees in life: death and taxes. Isn't that your phrase?
Yeah, exactly. And we're insuring for the one, right? So to that point, that's why a whole life is perfectly priced. People say, "Oh, it's expensive." Compared to what, right? What's it really doing for you? It's guaranteeing to pay a claim out if you die at 60, 30, 90, 105, whatever it is. It is guaranteed to pay a claim.
Yeah. Okay.
Oh, they have to charge it accordingly.
Yeah. And I think that's a good transition into, another question that I have more so just because of, again, working with you and kind of your values and your approach to these things is, how would you say that term insurance falls short when it comes to legacy planning, aside from, some of the obvious reasons and the fact that, again, once that term runs out, that death benefit isn't there, as opposed to, like you just said, with whole life, death and taxes, right? Doesn't matter if you're 30, 60, 90. One of the things that you talk about and is the legacy benefit that comes with it and the legacy planning. So
forth. The legacy planning idea really comes into two plays, right? One is in retirement planning. So people want to say, "Oh, I'm going to retire at say 65 or 70, whatever it might be." How I think about my retirement is different than I think about it at 45 for the most part. People that are 65 or 70 is like, "Well, I don't necessarily want to spend the principal. I want to leave something." Again, they don't care about their kids. They want to care about their grandkids. They cared about their kids enough, and now they want to care about their grandkids. I want to leave something for my grandkids, or I want some sort of legacy for me. And maybe it's not grandkids, but you know what I'm saying. And so the thought is like we change our perspective. We change kind of what we think about, what's important to us a little bit. And so now it's like, I want to leave that legacy. So if they don't have, like a whole life policy to kind of be that, I'm going to call it permission to spend all our money. And this is where the conversation might come into play is like, "Hey, Kira, you're 65 years old, you're 7 years old, you have this chunk of money, this asset that you want to spend down in retirement. And you also have this great asset called whole life insurance that will replace all that money for that legacy you want. Go ahead and turn it into a stream of income and feel free to spend." And there's a tremendous amount of freedom that comes by doing that. You from a legacy standpoint, again, the issue we have with term is it doesn't guarantee a death benefit at the time you die. Statistically speaking, we know that somebody that say 60 to 8 years old is at 85 or 90%. But most term insurance stop paying benefit at age 85. So just think about that, right? Mm-hmm. From a legacy planning standpoint, it falls short because it doesn't guarantee a death benefit statistically when you're supposed to die. Again, from a legacy planning standpoint, there's only one product that works. It's the product that guarantees a death benefit at the time that you die. Term insurance is just not that tool. It's a tool. It's a good tool when it's used right and serving the right purpose. Other questions you have? Other thoughts?
I don't think so. I mean, that was kind of the biggest thing. The only other thing that we kind of talked about was, just the cost overall of term insurance in the long term. But I feel like we've kind of covered that and bouncing around with some of our other questions. But no, I think that was the biggest thing was, we just have a lot of questions that come across with term insurance, and, you do see the difference in the premiums, and that tends to drive a lot of the questions, which then, well, this is so much cheaper and I can get the same amount of coverage, but it's going to cost me so much less. And, why should I do that? And so I think it's just kind of, in addition to all the benefits that whole life has from a standpoint of legacy planning, retirement, access to cash, things like that, it just kind of gives people a little bit more perspective.
Yeah. Thanks for kind of bring that back around, because I like to wrap this up with this idea of, it's the price isn't the value. The price, people say, oh, it's so much cheaper. And I really go back to Daniel Pink's book, Compared to What, right? He asked the question, compared to what? And price doesn't always denote value. Is it cheap? It's not cheaper. It's when it's serving its purpose, it's perfectly priced. But the analogy I would use is this. And I've told you the story, and I'll tell the listeners the story again. I was downtown Minneapolis. This was well before cell phones, so this kind of dates how old I am, right? And we're downtown Minneapolis, and we're out with a group of people. Kind of got separated from this group of people, and I'm like in downtown Minneapolis, and back there you go to the ATM. I need to grab a taxi, and I need to get home. I don't have any cash to pay the taxi ride, right? So this is way before Uber. So again, everybody that's listening, like, what do you mean? Just take an Uber? And I'm like, no, it didn't work that way. You had to actually pay cash to the taxi driver. So I'm downtown Minneapolis, and it's early in the morning. We're out having a good time, and I'm like, I just want to go back to the hotel room, but it would take me 45 minutes, maybe an hour. So I remember exactly what it was, $20. So I go to the ATM, need to get $20 to pay the taxi, and there was a $5 fee. I'm not 100% sure how to get back to the hotel room. Late at night, I needed to get out of there. I need to get home. So I was willing to pay that 20% fee in order to get it done. Was that expensive? Yeah. Was it valuable? You better believe it. I got tremendous value on the $5 I spent. But when I break it down to just the numbers, who in their right mind would pay a 20% fee just to get access to your own cash? But did I find value in it? You better believe I found a tremendous value in it. So I always try to ask people, is it the cost or is it the value that you're getting from it? So when we have a discussion, we have education, we try to describe and educate people on what the value is they're getting. And that's really the important part. What is the value you're getting for this? And why do you want to, take 10% or 20% of your income and put it in whole life? And once people understand and get what the value is, we get people absolutely, they get this idea once they've been educated. But again, most people haven't had the opportunity to absorb content because, again, the mainstream media, the financial entertainers are really focusing their presentations or their ideas to, I would say, if you make $80,000, you're in the top 70% of the income earners in this country. Mm-hmm. So what do they focus their message on? It's like people that are making, maybe less than $70,000 or $80,000 as a household. And so that's the information that they hear, and that's the education that they're getting. Doesn't make it wrong. It's just but if you want to expand and you want to grow, step outside of that and say, okay, how do I find value in what the wealth you're doing? And that's really kind of where we take our education. And we love sharing our education with people. No matter where you're at in your stage of life, it's how you think and, who you're going to emulate. If you want to be a millionaire, don't emulate, somebody that doesn't have any money, right? Your Uncle Bob, all the wisdom, the barbecue grill, but doesn't have a dime to his name. Do you want to take his advice, or do you want to take the advice of the guy that's the millionaire in your family that's like, here's how I was making money? And he's probably the quietest person in the room. Mm-hmm. Of course, your Uncle Bob. We all have an Uncle Bob, don't we? That's where I was going with that conversation.
Mm-hmm. I think that's all I got for you today.
Well, thanks for if we had a segment, we just call it the Consumer Corner, right? Let's call this the Consumer Corner. And if people have questions, throw it in. If you're on YouTube, throw it in the comments. Send us an email. Drop us a line. We love taking questions from consumers, from our clients, from the public. Because again, it's not about right or wrong. It's just about education. Because all tools used properly can help build your house. Thank you so much, Kira. Thanks for the time.
Thanks.
Thanks for listening. The first step to something better is seeing it differently. Stay sharp, stay focused, and we'll talk again soon.